Ladies and gentlemen, it's a great pleasure delivering a keynote about gold in Dubai when the price of gold is flirting with the price of 2000. My name is Ronald-Peter Stöferle and I'm fund manager at Liechtenstein-based Incrementum AG, and for 17 years we are publishing this report called In Gold We Trust. In the next couple of minutes I will present you my new keynote, which is called Showdown. And let us explore some of the showdowns that we are focusing on at the moment. If you search the dictionary for the meaning of showdown, you will get the following definition: a conclusive settlement of an issue in which all resources and all sources of power are used for, or the laying down of one's cards face upward in the game of poker. Now, in history, we have witnessed many showdowns, like Alexander the Great versus Darius of Persia. In business, Pepsi versus Coca-Cola, Apple versus Microsoft. And we're all looking forward to the great political showdown of the young, hungry political upstarts, Donald Trump versus Joe Biden next year. And you all probably know from the world of movies, one of the greatest showdowns: James Bond versus Ulrich Goldfinger. As you know, the plot revolves around Ulrich Goldfinger, the villain of the story, who's a wealthy bullion dealer who is obsessed with owning gold. Later in the film, we witness a plot twist. Goldfinger reveals his plan called Operation Grand Slam. So Goldfinger is not trying to steal the gold, but rather to set off a nuclear bomb inside the United States Bullion Depository at Fort Knox, rendering the gold inside as useless, and thereby sending the world into economic chaos and increasing the value of his own gold reserves. And there are some analogies in this movie that we've analyzed. But in the world of capital markets, we have identified three different showdowns: the showdown in monetary policy, the showdown East versus West, and the showdown in the gold price. Let's talk about the first showdown. Thanks to AI, have a look at this picture. This is not an eagle, but rather a chicken, because the Federal Reserve is playing a game of chicken against inflation. Who will budge first? We have hit the point where the Fed must choose between fighting inflation and financial stability. If the Fed chooses the tight road, financial markets will revolt and the carnage in bond and equity markets will continue. On the other hand, if the Fed chooses financial stability over fighting inflation, the Fed will risk losing the credibility that they have painstakingly rebuilt over the last couple of months. Have a look at this chart. It shows the federal funds rate since the year 1915. 2022 saw the third highest yearly increase in the federal funds rate since the founding of the Federal Reserve. If you look at this chart, you can see that only 3 out of 20 hiking cycles actually did not end in a recession. From my point of view, ladies and gentlemen, it's crystal clear, as these days higher for longer seems to be the new narrative, that the United States will move into a recession, a pretty nasty recession. And we've put out quite a lot of research about this topic. Dave Rosenberg said every recession starts out looking like a soft landing. If you have a look at this chart, it shows actually the so-called leading economic indicator. This is one of the most reliable recession indicators. Since the year 1965, it has successfully predicted every recession. And the beauty about this indicator is actually that it doesn't look through the rearview mirror like most economic indicators that basically tell you what happened over the last couple of months. No, instead it's always looking through the front window. The index has now declined 18 months in a row, which is the third longest decline in the last 70 years. Every time this has been larger than 6 months, the US went into a recession. Have a look at this chart showing credit growth. Credit, ladies and gentlemen, is the lifeblood of modern economies. Deteriorating credit conditions are both a signpost and a cause of recessions. And usually, if we see decreasing momentum of credit growth, it is already a warning sign. But look at the development at the moment. Actually, we're seeing negative credit growth, which is contracting credit. If you have a look at M2, M3, they are contracting. So actually, when it comes to monetary reserves or to money supply, actually it is a deflationary environment that we're seeing at the moment. So this, from my point of view, is a very, very clear indicator that the US will move into a recession. Now, let's reflect and consider which assets perform well during and after recessions. In our last In Gold We Trust report, we introduced the Incrementum recession phase model, where we said every recession has 5 different phases, each with different characteristics. And as you can see, gold is a pretty good recession hedge. Actually, on average, gold is up 10.6% over the course of the last recession since the year 1971, while silver, the S&P 500, and commodities don't do so well, especially in the first phases of the recession. In phase 4 and phase 5, this is the point in time when governments and central bankers really panic. They start to panic, and the R word, recession, is being read all over the place. This is the time to become more aggressive. And actually, what is interesting is that mining stocks prove to be a really good recession hedge. So, ladies and gentlemen, what I want to tell you with this chart, if you think a recession is coming, gold should be a very decent hedge. For silver, it might be a little bit too early. The same goes for commodities. Now, the second showdown that I want to talk about is East versus West. We've seen it through history. Alexander the Great versus Darius of Persia. Rocky Balboa versus Ivan Drago. You remember that movie. And of course, the Crusades and the Cold War. Now, in geoeconomics, it seems that we are approaching a showdown between the saturated establishment in the West and the hungry upstarts in the East. Of course, a central example for this development is the growing importance of the BRICS stage, which have in 2020 taken over the G7 nations in terms of share of global GDP. Now, with the addition of 6 new members, Argentina, Egypt, Iran, Saudi Arabia, and last but not least, the United Arab Emirates, this development will even accelerate. I don't know if you saw that tweet during summer. It caused quite a lot of excitement in the gold camp, I would say. It was published by the Russian embassy in Kenya. And it said that the BRICS countries are planning to introduce a new trading currency, which will be backed by gold. Now, when I read tweets by the Russian embassy in Kenya, I would say we should always take it with a grain of salt. However, if we dig into the importance of gold for BRICS, it is evident that gold plays a major role. Have a look at this chart. Jim Rickards already alluded to that this morning, and also John Reed. Emerging markets have increasingly building up gold reserves and reducing US dollar reserves since 2008, but the momentum has clearly accelerated last year. Central banks increased their purchases by 152%. To over 1,136 tons, the highest amount ever. And the momentum keeps on going strong. We've seen 800 tons of gold buying since the beginning of the year. Now, what was the trigger, ladies and gentlemen? It was obviously the decision of the West in February 2022 to freeze all the dollar and euro reserves of the Russian central bank. This will go down in monetary history. Why? Because we've seen sanctions against pariah states like Venezuela or Iran or Afghanistan before, but they have never been applied against a state with veto power in the United Nations Security Council, a former member of the leading economic nations, the G8, a nuclear superpower, and of course one of the world's most important exporters of raw materials. Now, what does it mean? The decision clearly demonstrates to many US critical nations how quickly US dollar reserves can transform from a highly liquid asset to useless pieces of printed paper. And this surge in central bank buying clearly shows an erosion of trust in institutions and the rule of law. Ladies and gentlemen, more and more countries will reconsider their FX reserves. The volume that we are talking about is enormous. The global foreign exchange reserves of central banks amount to 12 trillion US dollars, of which the US accounts for about 60% and the euro for 20%. So gold is re-emerging as a neutral monetary reserve, and it is one of the biggest beneficiaries of the troubling conflict East versus West. But it's not only central bank demand that is dominated by the East. It is also consumer demand. Now, China and India have gone from 28% of consumer demand in the year 2000 to now 50% of global consumer demand. India imported 17,000 tons of gold in the last 2 decades. Total gold stock in private hands in India is 29,000 tons, more than the combined gold holdings of the top 27 central bank gold holders in the world. It is said that just Indian housewives own more gold than the US does with its 8,100 tons. China imported in the last 20 years roughly 18,000 tons of gold. And while the official holdings by the People's Bank of China might be pretty low, a Chinese official recently said, when he was asked how much gold China actually has, he said, China owns gold through its people. Very, very important message. So, ladies and gentlemen, this is important, and you probably know it, but I delivered this keynote last week in Zurich and the week before in Lisbon. You know that the flow of physical gold has shifted from west to east. The price of gold is increasingly being made in Shanghai, in Mumbai, and in Dubai, and less in Zurich, in London, or in New York. Now, are we seeing a renaissance of gold as a central bank asset? Have a look at this chart. It shows global central bank gold holdings as a percentage of foreign reserves. Actually, from my point of view, central bank demand might become a main driver of this bull market. In the 1980s, gold as a percentage of reserves was 75%. Will it go back to that level? Probably not, but it could easily double to roughly 40% over the next decade. In the world of professional wrestling, this is called a heel turn. And now it seems that the great moderation is over and that we have really seen some sort of a heel turn when it comes to central bank gold reserves. So our view is clear. Gold is coming back into the system as a neutral reserve asset. Now let's finish with the showdown in the price of gold. Have a look at this chart. It shows lots of numbers. Obviously, green is a positive performance, red is a negative performance. Gold worked extremely well over the last couple of years. You can see gold in different currencies. I think it's always important when people say, well, gold didn't perform really well. I would ask in which currency actually. If you're in Japan, if you're in Turkey, I think gold did its job tremendously well. In US dollar terms, gold is up year to date 7.1%. In euro terms, 7.4%. In Japanese yen terms, 24%. The compound annual growth rate in that time frame on a US dollar basis is 8.4% per year. Not too shabby, I would say. And my friend Shane McGuire, who is the director at the Teacher Retirement System of Texas, recently said, I don't think the question really is, what is gold worth, but rather what are currencies not worth. And the interesting thing is, ladies and gentlemen, that Western financial investors, they still remain on the sidelines. The question is, when will they join the party? Global gold ETFs have seen 6 consecutive quarters of outflows. In 2023, we saw outflows of 225 tons, primarily from Western investors, North America and Europe, while we're seeing that for Asia, there are at least some inflows. So Western financial investors remain on the sidelines. But I think, and that's a very good sign, now gold trading at 2,000, people couldn't care less about gold. As soon as gold hits new all-time highs in dollar terms, I think that FOMO, fear of missing out, will kick in, and that new players will enter the field in a flash. I think that the investment demand for ETFs could tip the gold price scales. Now, this is obviously one of the big questions or the big mysteries in the gold world. It shows gold and tips, the 10-year tips. Historically, as we have seen, there was a very, very tight correlation between the yield on 10-year tips and the price of gold. But look at the divergence now. The correlation has totally broken down. Real yields, ladies and gentlemen, have risen by 350 basis points over the last 18 months. If you would have told me that real yields would rise that significantly and that you would get clearly positive real yields, and you would have asked me where's the price of gold gonna trade, I would have said 1,500, 1,600. But something happened. And I think that there's a new gold playbook that we should focus on. If we look at the time when the gap started to widen, it actually started with the Ukraine war, which led to those record high purchases of gold by Eastern central banks. And it also shows us that gold really doesn't believe the official inflation numbers. So this chart might be evidence for de-dollarization or de-euroization, but probably not into the renminbi or rupees, but rather into gold. Now, I briefly touched on the topic of silver. We know that silver is the young, wild little brother of gold. And I know that many in the gold world actually love silver. Now, have a look at this chart. If you think that we are moving into a strong bull market for gold, actually you should consider silver. But, as I've said before, if we're gonna hit the recession, then it might be still a little bit too early for silver. So you really want to see silver starting to outperform the price of gold. This is actually a very strong sign. But if it starts outperforming, well, this could be a pretty wild rally in the silver market. And this is probably my favorite chart. As you can see, from the points on when the Federal Reserve started to pause with their interest hiking policy, gold actually did tremendously well. Gold was up 66%. It was up 189% and 50% plus. So what I want to tell you with this chart is actually gold has been holding up tremendously well in an environment of dramatically rising interest rates. So the best for gold might be yet to come. The best will come as soon as the Federal Reserve starts lowering interest rates. And normally, Fed rate hike pauses lead to rate cuts. So I clearly don't believe into the higher for longer narrative. This already brings me to my conclusions, ladies and gentlemen. Decades of disinflation, the so-called great moderation, have ended. We should expect more inflation volatility. Inflation will become one of the key topics for portfolio construction. We should not forget that most portfolio managers in the Western world basically grew up in an environment of 4 decades of falling inflation rates. So inflation was the least concern for constructing your portfolio. I think this is going to change. We've seen an inflation shock, then a rate shock, and recession shock, and the next step will probably be the pivot. And I think Jay Powell, who didn't communicate too well recently, I would say, he kind of didn't really convince markets. I think the markets are already seeing that the pivot is on the horizon. Ladies and gentlemen, simplicity is the ultimate sophistication. There are many analysts, many gloom and doom people that would tell you that gold is the answer to everything. Gold is the solution for everything. No, it's not. It's just the hardest currency out there. Simplicity is the ultimate sophistication. That's what Leonardo da Vinci said. So gold is a simple and effective and a reliable means to hedge against inflation volatility, against equity and recession risks. And, of course, you want to see a price target. We are seeing $2,300 over the next couple of months, and based on our base scenario of an approaching recession. My technical target for the next 16 to 18 months is $2,700. Now this brings us back to James Bond when he faced off against the legendary villain Auric Goldfinger. Ladies and gentlemen, you don't have to be a Bond villain to get your fingers on gold, but you could have the Midas touch by turning a larger percentage of your portfolio into gold. Thank you very much for your attention. I hope you did enjoy it. And is there still some time for questions? Any questions? Ooh.
Ronnie, you showed a chart where gold does fairly well in recessions, and a separate chart where gold does fairly well when the Fed cuts interest rates. But of course, the Fed cuts interest rates in a recession. So I think that's an interesting correlation. They're two different ways of saying the same thing and really reinforce each other. I didn't know whether you had any comments on that.
Yes. I mean, the question is, you know, here in Dubai, and I have to say it's my very first time here in Dubai, unfortunately, and as my fellow countryman Arnold Schwarzenegger would say, I'll be back. So I'm really looking forward to coming here more often. But here it seems everything is buzzing. But when you come to Europe, it's actually pretty depressing. So Europe is already in a recession led by Germany. And in the United States, we shouldn't forget that the US, even though it runs, I think, basically full employment, and on the surface, GDP growth is still intact, but it's running an 8% government deficit. So there's an enormous amount of fiscal stimulus. So my take would be that we've probably seen this sugar high coming from this enormous amount of fiscal stimulus. We've probably never seen that outside of a recession in the United States. So as soon as this sugar high kind of wanes off, I think the Federal Reserve, the US will also have to deal with the R word. However, I heard recently that in the communication, you know, we've got an election coming up, they will try everything to avoid the term recession because it obviously is not going to help the Democrats. But I think the recessionary drivers are clearly intact, and I just don't see how the world, not only governments, but also private individuals and corporations can really deal with this enormous surge in interest rates.
Ronnie, John Reed here from the World Gold Council. Great presentation, thank you very much. I even noticed you use some of our data, which is always good to see, and suitably attributed as well, which is always good. You made a point in your presentation that the price of gold was increasingly being made in India and China, and indeed the UAE, rather than in the West. Is that really true? Have you done any statistical work to look into that? And the reason I ask is that I find it difficult to believe that even enormous gold producers can set the price of, consumers, I should say, even enormous gold consumers can set the price of gold when there's currency controls, when there's import restrictions, and when there's an inability to export gold. It strikes me that whilst these countries are still restricting gold flows, that they can't have the same sort of influence on the gold market as a free market system where gold and currencies can flow more readily.
Yes, it's a fair point, John, absolutely. I think that being made is probably the wrong wording, but I think that, and this is something that we in the Western world, and I don't know if you see that in a similar way, you know, from London, I think that the Western world still thinks that they are the center of the gold world. And if you just follow the flows, not only consumer demand, but also central bank demand and production. You know, China is the biggest producer for years. Russia is, I think, number 2 at the moment. I think it's clearly moving into Eastern markets. Yeah, I think, and this also has to do with the cultural affinity and, let's say, more of a gold history compared to Western, more financialized markets. Yeah.
$150 billion of turnover of gold a day, then I think the West still dominates.
Kind of, still, but it might change. And we're seeing, you know, the volumes being traded. The volumes being traded, for example, in Shanghai, they're picking up, but it's still a long way to go. But it is, I think it's important to emphasize that those numbers are just staggering. You know, those 18,000 tons that were imported to India in the last 20 years, it's just staggering. And I'm not sure if it's really coming back. It's kind of a one-way street.
Well, as I said before, if you can't export it, it's not coming back, not for now.
Yeah.
And look, there's no doubt about it in terms of the biggest gold holders, the biggest buyers of gold. I completely agree. If you look at it in terms of terminal demand and to a degree supply, as you say, there's no doubt about it that emerging markets are really important. I think our numbers are 73% of consumer demand for gold now goes into emerging markets. But the volume still trades in the West.
Yeah.
And I think that, to me, is an indication that India and China are punching below their weight in their impact on the gold market by the restrictions that they have on the imports and exports and trading of gold.
Thank you very much.
Well, please join me in thanking Ronald-Peter.